Hi there, this is Simon, personal finance coach. This video is about how to create a headache-free two-stock ETF investment portfolio that offers maximum upside with minimal amount of work. The inspiration for this topic came from my two wonderful daughters, ages 25 and 35, who asked for a coaching session on how they should invest their savings. They both have good jobs, good work-life and family balance, and they also able to put some money aside for savings. Their intent was to invest in stocks long-term with a minimal amount of time in managing the investments. Time freedom was an important factor in their considerations. They wanted to invest the money knowing that the money is working for them and not to spend hours researching stocks and stressing about investments. My immediate inclination was to suggest a few equity exchange traded funds known as ETFs, but instead of just giving out the ETF names, I suggested I would walk them through the process and explain how I picked the two ETF portfolio and what they need to know about them so that they have enough knowledge to adjust the investment strategy as needed to fit their own financial goals. I wanted my suggested ETFs be a starting point for them in making their own decisions and picking the right investments that work for them in their own strategies. If you watch this video to the end, you will find out what ETFs came on top and why. And in the interim, please subscribe to this video for notifications on future videos. I wanted to start with going over what is an ETF and what benefits ETFs provide. My daughters, being 25 and 35, recognize that they have 30 or more years to let investments grow, and they knew that investment in stocks provide the highest rewards, but they valued their time and did not want to spend time in researching stocks and worrying about investments. This is why a stock ETF, also known as equity ETF, was a perfect choice for their intentions. Equity ETF is a collection of publicly traded stocks that are selected to focus either on a specific index or a market or a sector or a particular investment theme. They cover a wide range of investment strategies catering to various investor preferences and objectives. Some of the common type equity ETFs available in the US market include broad market ETFs, sector ETFs, style ETFs, dividend ETFs, and quite a few others. For example, an S&P 500 ETF includes investments in 500 largest publicly traded companies in the US, with well-known companies such as Microsoft, Apple, and Nvidia, with broad holdings in all sectors of the market. A financial sector ETF includes investments in about 400 companies in the US operating mostly in the financial sector and includes companies such as JP Morgan Chase, MasterCard, and Visa. There are over 8,000 publicly traded stocks in the US alone, so ETFs, by holding stocks in numerous companies, provide diversification, enabling to invest into a wide portfolio of stocks through a single investment and helping to spread the risk. There are over 3,000 ETFs available in the US stock market, so selecting two ETFs from the broad offering required a systematic approach. The process of picking the two ETFs started with identifying the requirement criteria. This was a very important step since requirement criteria would point us to certain ETFs and would eliminate others. We came up with the following 4 points. Number one, the two ETFs had to represent two different investment strategies of the US stocks. Number two, the ETFs had to have a long history of 10 to 20 years of highest performance. Number three, the ETFs had to have a broad exposure in holdings and sectors. And number four, they had to be low cost. Because of these requirements and long investment horizon, we could get away not having a third ETF focused on safety, which is usually referring to value companies with dividends, because these companies would be included in either one or two of the selective ETFs due to the broad exposure requirement. In addition, for each of the 2 identified ETFs, there would also be several alternative ETFs that fit the strategy so that my daughters would be able to make their own decisions that fits their goals. So first, we looked at the various equity ETF strategies. To look at the possible choices, we looked at US equity ETFs category covering indexes of S&P 500, Dow Jones, NASDAQ, mid-cap, small-cap, micro-cap, ETFs, and Russell 2000. The next type of ETF category we looked at was US Equities Factors ETF based on value, growth, quality, low volatility, high dividend momentum, dividend growth, and equal weight. We also looked at the US equity sectors ETF category with all 11 equity sectors, including technology, healthcare, consumer staples, and 8 others, but decided not to include this category because they concentrated on a single sector, which was against our criteria of requirements. We considered global equities ETF category based on international market and countries, but decided to stay with US stocks per our criteria of requirements. After reviewing the categories against the criteria, we ended up with 2 category choices. US equities with 6 candidate ETFs tracking indexes of S&P 500, total stock market, NASDAQ, mid-cap, small-cap, and Russell 2000, and US equity factors with 5 candidates ETFs that invest in specific market characteristics for value, growth, low volatility, momentum, and equal weight, for a total of 11 candidate ETF choices. As the next step, we created a table for the identified ETFs with columns including representative symbol, cost, also referred as expense ratio, performance of the representative ETFs for 5, 10, and 20 years, top holding sectors, and top holding stocks. We identified 2 best performing ETF types for each of the 2 categories. For the US equities category, the top 2 consistent performers over 5, 10, and 20-year timeline were NASDAQ 100 and S&P 500 equity types. For the US equity factors category, the top 2 performers over 5, 10, and 20-year timeline were momentum and growth equity types. Since our criteria was to select the best performing ETF types with broadest exposure, we settled on S&P 500 type for the US equities category and growth type for the US equity factors category, since both had a significantly larger number of holdings in the range of 500, as we defined in the requirements criteria. As noted in the requirements criteria, we also wanted to have several alternatives for the identified ETFs, so we created another list with alternative ETFs for the S&P 500 and the growth ETF types that are available from different investment companies. The 3 S&P 500 ETFs were SPY offered by State Street, VOO from Vanguard, and IVV from iShares. The 3 growth ETFs were from ISUG from BlackRock, VUG from Vanguard, and SCHD from Schwab. We ran the historical performance numbers to the alternatives to make sure they performed comparably, and since all of them had a low cost, below 10 basis points, all were legitimate candidates for our investments. My personal favorites are VOO and SCHD. However, I wanted my goals to select the ETFs that they were the best fit to accomplish their financial goals. They were also in a position to decide on how much to invest in each ETF type, and if they wanted to do a 50-50 split between the 2 ETF types, or be more conservative with 60-40 split, or be more aggressive with 40-60 split approaches. The last thing I wanted to illustrate that with the 2 ETFs fund portfolio averaging a return of 13% per year, with consistent savings of $500 a month, each of my goals will end up with over $500,000 in savings in 20 years, or over $2 million savings in 30 years. This is the power of compounding investment. Please subscribe to my channel to get notifications on new future videos. Feel free to drop me a comment if you have comments or questions on the presented approach, and thank you for watching.